Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Dan Roberts, manager of the Fidelity Global Dividend Fund, which features on our wealth shortlist of funds selected for their performance potential. So Dan, with the Fidelity Global Dividend Fund, you can invest in companies from all across the world. So what do you look for, and how's the portfolio looking today?
It's a good question because there's 2,500 stocks in the index, so where do you start? And I think it's very important to have a clear view of what you're trying to achieve. For us, we're looking to deliver a solid risk-adjusted return across a cycle. So yes, we're looking to stay ahead of the broader benchmark, but also keeping a tight control over that risk. And you've seen that in the return profile of the fund's return over its history. You'll see it's much less volatile than the broader benchmark. And in periods of market stress, it tends to be very resilient. So what does that mean in terms of our approach and what we look for? And to answer your question, what kind of companies are we looking to include in the portfolio? Well, I'd say there's two buckets of risk that we're really looking to manage. First of all, the fundamental risk associated with the company in question. And I think the key word there again is resilience. So we're looking for attributes such as recurring revenue streams, brand equity, strong pricing power, good cash conversion, strong balance sheets and so on, which give the company that resilience. And then beyond that, we're looking to manage the valuation risk as well. So if a company has all those good attributes I just mentioned, but is priced for perfection, then it may be a very good company, but it might not be a particularly good investment. So when we're looking across that broad universe of that 2,500 stocks, we're really looking for ideas which tick both of those boxes. In simple terms, looking for resilient companies that are attractively valued.
And the fund's gone income focused, but within your dividend analysis, you place a lot of emphasis on the potential for companies to grow their dividends into the future rather than necessarily what it might be today.
Yep.
Why is that?
Well, I think the simple answer to that question is if you think about the return you get from equity over the long term, it's a combination of income and growth. So we don't want to chase the former at the expense of the latter. We want a good balance between those two components. So as you said, what that means in practice is, we don't indiscriminately chase yield into parts of the market where we think we shouldn't go. Instead, we place a lot of emphasis on thinking about the sustainability of the underlying dividend which underpins that yield. And if we can do that well, what you should see from the strategy is a growing income stream over time. And if you look at the results of the strategy over the 13 years since inception, when we started, the yield was a little under 4%. And we've grown the dividend at a 6% annualized rate over that 13-year period. So that's the bulk of the 11.5% total return you've seen over that 13 years has come from those two components. So like I said, it's about striking a balance. We could easily generate more income, but I think it would come at the expense of growth. And what we're trying to deliver is a good total return, income plus capital growth over the long term.
In recent years, global equity income funds have in general struggled to keep up with the broader global market. Mm-hmm. What do you put that down to?
Yeah, there's a few things going on there, but the dominant theme there is the outperformance of the US market, and within the US market, a relatively narrow cohort of US technology stocks. Why is that a headwind for income investors? Well, the US market itself is relatively low yield. The S&P 500 at the moment yields about 1.3%. If you compare that to Europe, the yield is a little over 3%, so very different. And then those US large cap tech stocks that I mentioned, some of those have very low yields or don't pay any dividend at all. So as income investors, they're kind of off limits for us. Having said that, that headwind, it hasn't been impossible to overcome. We've still managed to keep our nose ahead of the markets over the long term. And if that trend does change, if it does go into reverse, then that headwind can quite quickly become a tailwind, which is what we've seen actually in the first few months of this year.
And you talked about the dynamics in the US market there. That's an area where you're underweight. So where are you investing the fund and what are you excited about at the moment?
Yeah, we just talked about the strength of the US market, and this idea of US exceptionalism is getting a lot of airtime at the moment. But what we find on the ground is that we see much better opportunity in markets outside the US at the moment. So markets like Europe and Asia, for example, where we feel we can find as good quality companies which compare favourably to their US peers, but without having to pay the kind of rich multiples or valuations that you would if they were kind of domiciled in America. So if that's what we're seeing on the ground, that's how we allocate capital. And as you mentioned, that view comes across quite clearly in the portfolio construction. Beyond that, if I think about the kind of pipeline of opportunities we're looking at a stock level, there's no real theme to draw out. And that's quite common actually, because we see ourselves very much as stock pickers. So we're trying to look for individual opportunities rather than force a kind of top-down view into the portfolio.
And looking back over your career so far, Dan, what have you learnt along the way that might have been useful to know back when you started out?
The ability to maybe insulate yourself from market noise is key. We're bombarded with information nowadays. We have more information and data than we've kind of ever had before. And just being able to distinguish between signal, what really matters, and noise, I think is incredibly important. I think the other thing I'd call out is patience. If you have a long-term kind of investment horizon, which we do, then patience is critical if you want to hang around to see your investment thesis play out. So I guess two interrelated points, but both really talk to the importance of focusing on the long-term prize and not getting too kind of drawn into the short-term ebb and flow within the market.
And who would you say has had the biggest influence on your investment approach?
Yeah, so I guess when you're developing your investment approach, when you're starting out in your career, you read everything you can get your hands on, and you kind of latch on to snippets or words of wisdom from the investors whose approach kind of resonates with your own. I guess the names I would call out in that regard would be people like Seth Klarman or Howard Marks, perhaps. Maybe also worth mentioning, it's not an influence of an individual, but I started my career in fund management, at least, at a time when the dot-com bubble was bursting. So I think from a very early stage in my career, the importance of valuation and not getting drawn into the kind of prevailing narrative was made very clear to me, and that's something that stuck with me throughout my career.
And outside of work, how do you switch off?
Yeah, that's a good question because, well, as an investor, I'm sure you're well aware that you're always thinking about the investment implications of everything you read and see around you in the world around you. So it's not easy to switch off. Look, I have a young family. Taking them to clubs and watching them in competitions and shows and so on is something I enjoy doing. I also play golf, badly, it must be said, but I manage to get out most weekends. And that comes with its own frustrations as a game, but it's a fantastic way of switching off for a few hours on the weekend.
That's great. Dan, thank you very much for joining us.
Thank you.